the time. It doesn't really matter though. It's a service to my members. So here we go, 16 minutes. Time for another stock review. This time, it's a members-only special, members-only day today. From time to time, I like to do members-only days. So this is a members-only stream, making this live, and it's a members all-day stream. I'll be here all day doing reviews, and we're doing the paid ones first, and then we're doing all the free ones to follow. So become a member when you watch this video, and I'll do free reviews for you on Members Days. Okay, so here we go. Today is an unusual one because we're looking at a comparison. Altria versus Philip Morris International. This was requested by Tim Rogers. So we're looking at Altria versus Philip Morris tobacco companies. Which one is best, if any at all, compared to the S&P? Let's have a look. So if it's your first time here, please click subscribe and ring the bell. This means nothing right now because I'm making this live in a members-only event, but please tap the like button and I will reply to all of the comments from my members. All right, this is going to be like a 12-hour stream today, back-to-back, making as many reviews as possible. So let's start by looking at the basic chart for each company. Altria, if we look at Altria over the long term of the maximum chart available here compared to Philip Morris is up 105% over the max and 707% for Altria, so over the same period. What is Altria? Well, Altria is a holding company which engages in the manufacture and sale of cigarettes in the United States. It operates through the following segments: smokeable products, oral tobacco products, and all other. Let's have a look. Smokeable products segment consists of cigarettes manufactured and sold by PM in the USA. And machine-made large cigars, pipe tobacco. I think we get the idea. The CEO, William F. Gifford. We'd love to have William on the show. We'd have a Meet the CEO series. Look below in this video and you'll find the invitation for the CEO. Invite the CEO video, and your investors will message you via the email, investor relations, or they'll set up groups, and I'll provide news like this, reviews, earnings reports, and you are very welcome on the show. 6,400 employees, headquarters in Virginia, 1919, been around a while. Okay, how does that compare to Philip Morris, which has not had such a large growth over the same period? Philip Morris engages is a holding company which engages in development business of delivering a smoke-free future and involving a portfolio for the long term, including products outside of the tobacco and nicotine sector. It operates through the following segments: Europe region. So this is the smokeless business. So it's in the smoking business, but they are the smoke-free option, if you like. And as you can see, they've made less money over the period. Anyway, Jacek Zach, love to have you on the show if you'd like to be on the show. Employees 82,000, and this is Connecticut, and they've been around for 1847. All right, now then, so we'll go back now to Altria at the moment. So obviously Altria at the moment is coming out on top from the point of view of the since 2000, which is a 24 period. We can see that it's had the most growth. All right. Well, so we look at if we look at Philip Morris over the same period, 2008 though. So we've got to bear that in mind. 2008. So it's 8 years advantage. So if we go the last 5 years, 31% compared to down 10% over the last 5 years. So actually, it's because Altria have been going obviously longer. Yes, Altria have been going longer, but over the last 5 years, we can see that the traditional smoking product, if you like, is down at 10% over the last 5 years, but PM is actually up over the last 5 years. So far we can see that a smoke-free future, I'm assuming we'll learn more in a minute, the vapes, all that kind of stuff, perhaps is doing better. So I apologize for being misleading at the beginning. I'm learning as we go about the companies. When I did the maximum chart, Philip Morris obviously didn't look so good, but actually it's it hasn't got as much history as Altria, but it's done much better over the last 5 years. So anyway, we'll look at a much bigger chart in a minute. We're just starting off with the basics. So let's go back to MO. It's a little bit confusing, I know, going backwards and forwards, but we are comparing two together. So first of all, we're looking at MO, and it's a 73.79 billion market cap, and we can compare that to Philip Morris. This is the smoke-free one, 159 billion. So you can see the smokeless company is doing much better now than the traditional tobacco company. But on the on MO, we have a 9.72 earnings ratio. Okay, and here we have a 20 earnings ratio, which means that because it's more trendy and it's newer and it's more modern, people are potentially, and we don't know this yet, potentially overbuying the stock. It's doing well and they're overbuying it, so that it does look more expensive at the moment. What about the dividends, though? This is a dividend-paying stock. Dividends on PM is 5%. If we look at MO, 8.36. So we have a better dividend on MO than we do on PM, but we've not had the growth. So very often you'll get a stock which will give you a better dividend, but it will have a lesser growth. So we have to be very, very careful about that. That the dividend could look attractive, but if the stock is losing us money or not growing, it might end up being better going for the one that has a better dividend, less of a dividend, but it grows as well. All of that we have to compare in a minute. Anyway, so sticking with MO at the moment, 52-week high, 47, 52-week low, 39. So we can see we've got some volatility there. Whereas if we go back to PM, we've got 104 week high and a 52-week low of 87. So about the same sort of volatility between the two, roughly. Not doing heavy calculations there. We're just looking at the general look at the moment. Right, let's scroll on down. And if we look at MO, we can see this company, this is the smoking company, the traditional smoking company, has pretty much flatlined. But there's nothing wrong with that. There's nothing wrong with that. It's like Coca-Cola, J&J, and all these businesses. They're just business as usual. They're not growing. I mean, pretty much anybody who wants to smoke is smoking, and people who don't smoke, don't smoke. I mean, you know, it's a flat line business. It's just making money consistently, paying its dividends. Nothing wrong with that. It's not all about growth. It's just about good, solid business, making money, paying it out in dividends to the shareholders over a long period of time. That's what you want, right? So it's making money. It's not really growing. It's just trending along the same line. Because it's a stock which has a lot of history. If you can see Wall Street analyze it pretty good. Look, it's pretty solid. No major surprises. And if we look here, you can see who else is buying it. Realty Income, old money, long-term investors, AT&T, Verizon, Philip Morris, of course, is in there as well. 3M, Coca-Cola, solid investors, no gamblers. We're not going to have any short interest on this. It's a good investment. It's a good business. All right. Okay. Let's compare that now to Philip Morris, which is the smoke-free version, which has had the better growth recently. Let's scroll down and see what they're doing. Same sort of thing. We're making money, but we're kind of trending along the same trend. I mean, the smokeless versions have been out for a while, so people who want to vape and do smokeless versions are doing it. People that want to smoke regular are doing it. Nothing's really changing. There's no real trend so far. Obviously, Philip Morris has had the growth because over the last sort of 10 years or since 2008, it became more popular. But now it's kind of just trending along a basic line. And again, the same thing we can see. No real surprises with Wall Street. It's slight beat perhaps here. In fact, they have beaten. This one, here. A slight miss there, but beat again. So they're tending to beat Wall Street a bit more regularly than the other company, Altria. We can see Altria there. Again, Coca-Cola, Verizon, it's the same people. The same people are buying the same stock. So it's a stable stock. It's an investment company. It's a good company. It's a solid company. Anyway, we'll come on to the balance sheet in a moment. All right, so there's the basic look. Let's look at Philip Morris, what the analysts say. The bulls are saying cigarette loyalty tends to be strongest in the highest price segments, and with its positioning skewed to premium brands, PMI is among the best positioned to benefit. Bears are saying a great deal is undetermined about the tax and regulatory environment of cigarette alternatives, which could play a significant role in the future profitability of the business. That's an interesting point. Of course, when we talk about cigarettes, there's tax on it. And I don't know, I'm not a smoker, but I would assume that potentially I follow the budget in England a lot, when we have the budgets. And duty and tax is put on smoking and cigarettes. I'm assuming, and I'm only guessing, that the smokeless version has perhaps had a bit of a easy run of it for a while, because for a while we were encouraging people to do that. Now we're discovering actually it's not all so good in that. It's not all good for you in that sector either. But maybe in the future, they'll get hit harder. I don't know if they are hit at all yet. I'm just learning as we go. But maybe they'll start to have higher taxes put on them and their profits will come down. I don't know. Anyway, that's worth thinking about. Let's see how that compares to the Bears and the Bulls if we have anything for MO. The Bulls say relatively low capital requirements allow the company to return significant capital to shareholders in the form of an 80% stated dividend payout ratio. 80%, so it's not a dividend king. 80% dividend payout. Coca-Cola, J&J, always pay out, always increase. They're dividend kings. This is maybe what Tim was saying the other day about, he was talking the other day about dividend kings and dividend aristocrats. Maybe, let me just Google that a minute and see what I find out about that. Dividend, I've never heard of that phrase before. Dividend king versus aristocrat. Dividend. Now, before I read this, I'm assuming dividend kings are always rising, always beating, always paying out, and perhaps aristocrats not quite as good. I'm just guessing. I haven't looked at Google. It's on the other screen. I just wanted to make my guess, and now I'm going to look. Dividend aristocrats consistently increase their shareholder payouts. So I was wrong there. Year after year for at least 25 consecutive years. some dividend aristocrats are also dividend kings, which have increased payouts for 50. Oh, so I was right. I was right. So dividend aristocrats consistently increase their shareholder payouts year after year for 25 consecutive years. Some dividend aristocrats are also dividend kings, which have increased payouts for 50 consecutive years. So aristocrats is of a lower level than kings. Coca-Cola, J&J, kings, and aristocrats. What we have here are aristocrats, because we know that, because we just talked about the 80% of the time. So we know that. Right. That's interesting. Thank you again, Tim, for giving me these challenges and jobs to do, because I've just learned something. 25 years plays 50 years. So that's the difference there. All right. We just learned something. Every day we learn something. Right. Okay. So now we know Altria is the smoking version, pays a higher dividend but less growth. Philip Morris has greater growth, slightly less of a dividend, but still very good. Both of these are aristocrats, not kings at the moment, and not as they haven't qualified for that, but still very good. Philip Morris, being smoke-free, is having maybe a better run at the moment, but will tax positions change? Maybe they already have, or they already are. I don't know. I don't know all the legal stuff, but that's the issue with the newer style of smoking. Let's go and look now how they compare to dividends. Right now, obviously, they are different prices, so don't get confused here. Obviously, we're looking at Altria at $45, and it's just changed. Let me put that back in there. It does this before the bell goes. It'll keep changing. So $102.45. So they're not the same price. So obviously one's going to have a higher dividend than the other. We already know what the percentages are. So when we look at the value in a second, let's not be too concerned that one's paying you more, you're paying more for the stock. The percentages is what's important. So if we look at Philip Morris first of all, we can see, if we scroll back a little bit, let's go back to 2014. It's in cents, of course. So 102, 102, 102, 104, 107, 107, 114, 114, 117, 117, 120, 125, 125, 25, 27, 30, 30, 30. There you go. Pretty consistent. These are aristocrats, just not kings, don't have the history, but they have a decent amount of history. All right. Let's now look at Altria. Altria. Let's have a little look. Let's scroll down a little bit. We're not going to go forever and ever and ever. This is 2015. We did the other one to 14, so why not? 48, 52, 52, 56, 56, 61, 66, 70, 80, 80, 84, 84, 86, 90, 90, 94, 98. There you go. So you can see both good, solid dividends. 80% of the time we found out about, I think it was Altria. But I don't know what the full history of Philip Morris is. But there you go. Pretty good. Always increasing, always paying out, pretty much. We don't know. We can't go back to the very beginning of time. But there you go. Now then, if you're investing in these, the question is, which one is best? Right? Well, so we have to put the S&P 500 in, which is the top line. There's VU and the S&P, of course, following each other. So you could have made more money on the S&P. That's already clear as day. The S&P, if you bought the S&P, which is what I do, not just because I believe in it, I do it to be impartial. If you bought the S&P, $10,000 back in, when did we do this? 2015, which is as far as we can go back, because one of these companies is newer, of course. So 2015, is when we started our 2015 is when we started. If you'd put $10,000 in the S&P, you'll now have $30,000. You 3x'd. You're very, very happy. That's reinvesting dividends, as all of these are. So just note that. Philip Morris, you'd have had 20,000. You'd have doubled your money. Altria, you would have had 16,000. And that is including investing the dividends. So Philip Morris being the newer one, more trendy and all the rest of it, smokeless, has made you more money than the traditional company, and that is reinvesting the dividends. So, it's the same. Philip Morris has provided a better deal, as we saw from the growth. It had the growth and just a slightly less dividend, percentage-wise, so pretty good. But you could have made more money. Hate to be boring, but there you go. Making money is exciting if you like boring. I like boring. I watch Coronation Street every night with a cup of tea. I like boring. Boring's exciting to me. Right? I don't like surprises. I kind of do. Yeah, I like surprises, but I like to always make money and never lose money. That's important, right? If you're always consistent with not losing money, you're going to do all right. It's when you gamble and then go, I made loads of money on this one and, whatever. It's never good. Anyway, so the S&P comes out on top. You can see it kind of follows the same trends as well. And that's important because you can see the macro conditions in 2020. Let's have a little look. 2020, S&P dipped. So did they. That's interesting, isn't it? That's interesting. You think, well, everyone's at home. Why would it dip? Well, it did. More people had money. I mean, more people are at home depressed and frustrated. I would have thought the smoking companies could have done better, but that's a good and bad sign. It's a good sign that they're not affected by macro conditions out of the ordinary compared to a stable S&P, but they didn't benefit from it either, which is a shame. But if they had benefited from it, there may have been some fall off later on. I don't like companies that are doing well because of macro conditions, because they're likely to fall away when those conditions go away. But there you go. Generally, it follows the S&P, but not as much. And you can obviously S&P's got more tech in it, so of course you've got that explosion at the moment. That's why you're making more money with the S&P. Right. Okay. Now then. Now we're going to look at some numbers. If you like this so far, please tap the like button. This is members only day. Coronation Street, like the Antique Roadshow. Bloody right. Yeah, right. Good old-fashioned TV. I love it. Nothing wrong with it. Right, tap the like button. Here we go. So now we'll look at the numbers. If we look at Altria, it is undervalued by 41%. So this is the old school. This is old smoking, right? Undervalued 41%, and it's reliable. Philip Morris, undervalued by 5%. Makes perfect sense. It's more modern, it's newer, people are buying it, sexy, rock and roll, yada, yada, yada. It's obviously, just like a Tesla, people buy it, it gets overbought. It's not overbought, but it's less of a deal than the old school smoking, if you like. That's a better deal. I would buy the S&P. I wouldn't buy it anyway. So it's not a buy from me, but Altria is the better buy right now from a standpoint of value. Bearing in mind, we know what smoking does. We know what smoking is. The new smoking, the vaping and everything else, what if we discover it? And we are discovering it's not as safe as we thought, and it starts getting heavily taxed. Then it will start coming in line with the main with Altria, and Altria is better value right now. So maybe we've had a good run with Philip Morris. Maybe Altria is the better alternative if you are thinking of these stocks. Let's scroll down. Revenue for Altria is 24 billion. Revenue for Philip Morris is 35 billion. 35 plays 24. They're growing, as you can see, whereas the old school is kind of just going sideways. Let's look at the balance sheet. Altria, first of all, 36 in assets. Billion, that is 65 in assets for Philip Morris, but they've got 75 billion in liabilities with long-term debt of 44 billion. Ooh, let's see how Altria do. Oh, much better. 36, 41. No, it's not. 36, 41. I beg your pardon. Long-term debt, 25 billion. So they both have a lot of debt. They both carry debt. But I guess companies like this can afford to. They're just solid companies. It's like I have margin. My portfolio is solid. It's reliable. I can hold margin and I can just, it's okay. I've got a steady rising business. If you like my investments, they hold debt. Let's compare the solvency scores and the margins. This is MO. This is MO. This is Altria, old school. 58% margins. New school, 64% margin. So they make a lot more money. Now, I don't know if the tax is part of that and if they're getting an easier ride. And at some point, we talked about that earlier, potentially they're going to get more tax put on them. Those margins could come down, but they're making more money out of their product. 64% gross margin compared to 58. So you can see it there. Net margin of 35 in old school, Altria. Philip Morris, net margin 22. So the net margin is higher with Altria. Interesting. Right. Let's have a look down at the profitability score. So Altria, old school smoking, 64% profitability. Philip Morris, 56% profitability. So it had a higher gross margin, but its net margins weren't as good. 56, still okay, still good, makes money, but doesn't do quite as well as the old school, 64. And you've got those new debt, you've got those taxes issues. What about solvency score? Old school Altria, 51%. Philip Morris, look at that, 51%. Identical when it comes to balance sheet solvency. Old school, we're talking 4% upside from Wall Street. Philip Morris, new school, if you like, 9%. Not massive amounts in it. Yes, it's double, but it's not like one's 100%, whatever. Anyway, let's scroll on down. Let's go back to old school. Old school have been selling it recently. New school, Philip Morris, they've been selling as well. Okay. Old school Altria, 2%. I said they wouldn't have any short interest. 2% short interest. Philip Morris, even less. Kind of makes sense. It's got even less. People are thinking they're short the old school, the old guard. It's a thing of the past, maybe. I don't think so. I think people will always smoke. I don't smoke, never smoked in my life, but I'd imagine that people who like to smoke and tobacco will always do it. I think what we've got now is a bit of a fad, in my opinion. Might fade out, but what do I know? I'm not a smoker. You shouldn't ask me, should you? I'm the last person to ask, really, when you think about it. Let's have a look at it. Altria. This is the sentiment over the last 7 days. So we've got 90 days, really good, really good, really good, really good. I mean, sentiment is great for good old-fashioned smoking. What about smokeless? It's good. Oop, dropped off. yeah, bit of not negativity, but just some neutral news. So let's round this up. We've got a battle here between old guard, good old-fashioned smoking, and smokeless smoking. Smokeless has a higher growth, made more money than you've made with Altria. We made since 2015 $10,000 reinvesting your dividends on Altria. 10 grand turned to 16. Philip Morris, 10 grand turned to 20. So we made more money with Philip Morris, but it has a little bit more negativity or neutral recently. Potential tax situations. It's not as trendy anymore. Whereas old-fashioned smoking will always be around. I would imagine they might get more tax put on them, but so far, recently in the recent years, you've made more money with Philip Morris compared to Altria. But Altria, old school smoking is probably better value right now. I think that's always going to be around. The other one, Philip Morris, might not be as popular in the future. Tax situations. There you go. So remembering though, you can make more money just owning the S&P. Is there any reason to buy it? Diversity, you quite fancy the idea. Maybe you work in the sector. Maybe you're a smoker and you like to feel that you contribute to your dividend every month. Either way, they're both solid companies. I think I don't think smoking's going to go away. I think I'm just guessing, people just want to smoke a cigarette. I don't smoke, but I guess, that'll never go away. A new modern idea. I'm not so sure. And now we're finding more things out about it, and then more tax gets put on it. Anyway, there we go. That's my thoughts on that. That's a review. We are Members Day today. I know the bell's just gone. Thank you for letting me know. I'm not concerned. My portfolio is breaking all-time highs every day. I don't even need to look at the bell. I know rates are coming down in the summer. I know they are. I don't care what Bloomberg and CNBC and Jim Cramer and Meet Kevin and any Tom, Dick and Harry tells me. Look at the numbers. It's clear as day. So there you go. There's my review. Our first review on Members Day, a very long one because that was a comparison one. Please don't give me one of those again. That took ages and it was very complicated. Anyway, so there you go. So for me, probably I'm going to go for Altria as the best buy out of the two because I think old style smoking will always be around. I think people just want to have a cigarette, cigar will do it. The smokeless one might have tax implications down the line. It's not as good value. It's overbought at the moment. They're both going to pay solid dividends. They're both solid companies. But if I had to buy one, I would buy Altria. But ultimately, if you just bought the S&P, you get exposure to these and the same volatility, but you get tech built in. So for me, it's a no-brainer. I would just buy the S&P. There's my review. Members Day. All day Members Day. Click above my head for more information. Down below in the description, you'll find my alpha spread, martynlucas.com, above my head. And just before I end the review, the gentleman who asked me to do it is saying, so let's have a look. Philip Morris, the new school, split these companies because of US policy and taxes. Remember, diversification is the key to investments. I own 20% of these companies along with holdings in the S&P and 80% in dividend stocks. There you go. That's Tim's final thoughts. I am going to say, not in contradiction to him, but I'm going to say anyway, don't get overly enthusiastic about being too diversified. Now, you might say, well, you're diversified. You have 500 companies. You own the S&P 500. Yes, but I don't own 500 companies equally. If you look at number 500 on the S&P 500, it's probably 0.0001% of the index. So I wouldn't buy 500 individual companies because I couldn't look at them. And I think Warren Buffett is right. You only need 4 or 5 great businesses that earn money for you 24 hours a day to reach your goals and to make you very rich and successful. Diversification is a good thing, but it gets oversimplified and everyone thinks they have to diverse beyond diversification and buy everything. Well, if you're just going to buy everything, you're not going to be able to understand anything. You're not going to be able to manage anything. You can't follow the news for everything. If you just think, sod it, I want to buy everything, then you might as well just buy the S&P and be done with it. At least it's managed and the rubbish companies get thrown out, and CrowdStrike, example, join the party like they did on Monday. So you don't have to have huge amounts of diversification. I think ultimately what it comes down to is the S&P is going to always produce the goods for you. However, it's fun to invest, even if it's boring. It's not boring for me. It's fun because I like to know that my businesses I imagine it every night. Coca-Cola selling Coke, McDonald's selling McDonald's. You know, I love to own the businesses. It makes sense. It makes sense to own businesses that earn you money every day. It's a great feeling, right? But if you are interested in one sector, I know that Tim Rogers, I think, had worked for, I think, Coca-Cola or Pepsi. You understand the business. It's a great business and you want to own it. And if you own the business, and I mean individually, like I used to own Coca-Cola, I kind of liked it. And whenever Leah went to the supermarket, I know it's silly and it doesn't mean anything, but I always used to joke. I said, brilliant, just put another couple of bucks in my portfolio there. Let's buy some more Coke. So you do feel connected, and being connected sounds silly, but it's not, because if you feel connected, you tend to hold your businesses, don't trade them, and you'll make more money, and you feel comfortable. And if you feel comfortable and you're happy and you own what you know and you know what you own, you're going to do well anyway. So nothing wrong with buying a few things you like along the journey. Click above my head, down below in the description, over here and over here, I'll put my Alpha Spread reviews, and down here I'll put Sensei's The Oracle of Investor Street. He does the chart version. I look at the fundamentals and the real information, things you actually need. And Sensei, well, he does the